Thanks very much. Thank you very much for the intro. So yeah, I was previously at Amazix. I'm now a partner at Delphi Digital. Just to give like a really brief on Delphi Digital before we go into the talk. We're one of the leading institutional grade research firms in the space. Our customers are some of the top funds and investors in the space. We've covered projects for over 2 years, written sort of over 150 reports. And since then, we've also developed a consulting arm where we work on kind of token economic model and design for a bunch of the top projects in the space, like Aave and Synthetics and Compound and a bunch of others. And we also have a fund now where we invest in the most kind of promising projects that we find. So yeah, today I wanted to kind of focus on DeFi. DeFi is a sector that we've been looking at for about 1.5 years now. And recently, with kind of the yield farming craze and the recent market drop, we've been hearing a lot of people talk about the end of the so-called DeFi bubble, that the market is topped, and all that kind of stuff. And so what I wanted to spend time on today was just taking a step back and really taking a longer view of DeFi. Like, what is yield farming? How does this compare to the ICO boom? Because we hear a lot of those comparisons as well, and also where we are in the cycle. So the first thing to remember, and if we can go to the next slide, is that speculation has always been crypto's killer app from the very beginning. That the ICO boom is kind of what brought most people into the space, and it's what most people remember most clearly. But crypto's history is actually dotted with boom and bust cycles, not just in Bitcoin, which obviously has some very well known and prominent cycles, but also even with stuff like Namecoin and Mastercoin. And both of the charts you could see there could easily be charts from the ICO boom, and these happened in 2013 and in 2014 respectively. So this has always been kind of part of crypto. For those who lived through the ICO madness, a lot of the recent food coin stuff with DeFi can bring back some kind of painful flashbacks. If you go to the next slide, this kind of some painful flashbacks and also some memories of kind of the When Moon crowd and all of that. And so what I want to spend some time on now is just defining kind of what I see as the main similarities between them and also the main differences between them. While the underlying mechanism between the ICO boom and there it is. But while the underlying mechanism between the ICO boom and DeFi that is the same, there are also some really crucial differences that are important to remember. So ultimately, first of all, we have to kind of admit that the majority of the yield that was available in DeFi, the sort of astronomical 1,000% APYs, or in the case of something like YAM, even like 10,000% APYs, were powered by the exact same dynamic that powered the ICO boom, which is speculating on overpriced altcoins. While in the ICO boom, this was reflected in rapid price appreciation. ICOs that sold out in seconds and then proceeded to kind of 10x over the next few days. It's now reflected in astronomical APYs paid out in crop coins whose price is sustained by those unfortunate enough to buy rather than farm. And if we go to the next slide, we can kind of see a good example of that with Curve, a project that we're going to dive into the fundamentals later, has done very well fundamentally, but whose chart looks as sad as many of the saddest kind of ICO boom charts. So that's kind of the similarity, right? There's always someone on the end of the trade buying that's kind of powering the astronomical APYs. But there's also some really critical differences. And I think that the genius of yield farming is it transforms what's always been crypto's inherent fondness for speculation, which I explained before was crypto's killer app, into fundamentals, into growth, and into community. So it transforms speculation into this positive feedback loop that actually generates fundamentals for these projects. So unlike with the ICO boom, where you would distribute tokens to people who are willing to pay for them, the genius of yield farming is that you're distributing tokens to the actual users of the network and incentivizing them to contribute work, time, and ideas. Right now, most of this is in the form of liquidity. But what it's done a really good job at is incentivizing the bootstrapping of the supply sides of these networks. And what that does is it drives down costs, which makes the demand side more profitable as well, or more sort of useful as well, because you can now transact with much lower costs. And so from our perspective, this has been incredibly successful, and we're going to go into a few examples, because it creates this community of supply siders and users who all have skin in the game and are incentivized to contribute their time, work, and ideas to the project. So one really good example of this is Curve. So if we go to the next slide, obviously we saw that Curve had a very sad price chart, but actually the fundamentals are much less sad. Curve attracted over $1 billion in liquidity in a few months, and it still offers better execution than centralized exchanges on some of its pairs. And this is an idea that was simply unthinkable a few months ago. And we can see here Uniswap is the exact same thing, right? Uniswap offers better execution than centralized exchanges for quite a few different pairs. At the end of July, Uniswap recorded more volume than Binance, Gemini, and Poloniex combined. And in August, there was a few days where Uniswap achieved higher 24-hour volumes than Coinbase. And so it's important to realize that this was an idea that was inconceivable a few months ago, right? Before kind of the launch of yield farming, DEXs were kind of laughed at. They were less efficient, they were slow. People thought they were never going to work. And now we actually have two DEX projects that offer better execution than their centralized counterparts, and that have generated billions of dollars in liquidity and millions of dollars in fees for liquidity providers. So, and this couldn't have been done without yield farming. And that's the sense in which this isn't just speculation. On the other side, you have projects like Yearn that have shown the power of yield farming and fair launches and bootstrapping an insanely strong community consisting of many of the smartest people in the space. And Yearn's now at obviously nearly 500 million in AUM. But most importantly, they're constantly innovating and generating their decentralized hedge fund, generating some of the best yield farming strategies and ideas out there, and kind of consistently expanding their ambitions. So these are just three examples of the many that I could cite. And I think the key takeaway is that the DeFi boom is bringing with it real innovation and value, which is dramatically different from what was happening in the ICO boom, where the majority of projects didn't even have a live product, let alone any traction. So if we go to the next slide, we can see that these are two projects, Aave and Synthetics. Both of these were funded via 2017 ICOs. And after iterating through a bear market that saw their prices drop by over 95%, both have landed on products, on DeFi products with product market fit, and vastly surpassed their ICO valuations. And this sort of lines up really well with what the innovation framework of Carlota Perez, which we can see on the next slide. So Carlota Perez is a framework for technological revolutions, where technological revolutions start with the installation period, which always, and this has been the case in kind of all technological revolutions throughout history, from the Industrial Revolution to canals to radio. All have kind of underwent these cycles where you have the eruption, and then you have a frenzy, which ends in a bubble. The bubble pops. Everyone thinks this isn't going to happen, similar to the sort of 2000 bubble popping. And then the builders continue building. They use the funding from the era of the frenzy to kind of keep iterating on their solutions. And then there's the slow kind of growth towards maturity and I guess being widely used. And so this is kind of what we see with really clearly with DeFi, where a lot of the leading DeFi projects were actually founded 3 years ago, right? In the ICO boom, that's what funded them. And now we're seeing the results of all that work and kind of sowing the seeds for the next phase. And then, so just keeping in mind a bit of the longer term, what's important to remember about DeFi is that the value proposition for DeFi is not sort of yield farming crop tokens for thousands of percent APY. It's doing to finance what the internet did to data, right? Transforming financial primitives into money Legos. We go into the next slide, and creating an open ecosystem that really enables permissionless innovation. So we really see, and we're kind of seeing it with some of these money Legos from Maker, providing decentralized stablecoin, censorship-resistant stablecoin, to Aave providing credit markets, Wi-Fi, decentralized hedge fund. All these different primitives are coming together to really provide an alternative financial system of the future that we see not only collapsing the cost of financial services, but also making them accessible to a much broader swath of people. And similarly to the internet, once again, we think the internet starts off with email, which people see as a faster letter, right? We take a use case that existed in the analog world and we put it online and do it better, and that's kind of the initial use case. But what we see with time is that the internet, like all kind of innovative technologies, actually ends up enabling entirely new use cases, right? Like social networking, something that couldn't have been done with a letter or with any of the analog technologies. And that's what we're seeing with DeFi as well. Flash loans and automated market makers are arguably an example of one of these entirely new use cases that couldn't exist in traditional finance. Automated market makers are kind of opening up liquidity for the long tail of users that aren't professional market makers. And so it's really important, if we move on to the next slide, to kind of keep in mind what the end game is here. Finance is the world's largest market for consumer software, sorry. So DeFi's total addressable market is in the trillions of dollars, right? And to put this in perspective, the cumulative market cap of DeFi right now is currently at 13 billion. So when we talk about a bubble kind of popping, it's important to keep in mind what the vision is and how early we still are. And then in comparison, if we look at kind of the cumulative market caps of some of the inactive layer 1 projects that are out there right now, like Ripple, Bitcoin Cash, Bitcoin SV, Litecoin, EOS, Cardano, Tron, Stellar, Neo, and NEM, their cumulative market cap is 32 billion. So a lot of these projects have very little activity, and their market cap is kind of 3 times or nearly 3 times that of DeFi. So in the short term, we think even if no new money enters the space, we see kind of a repricing from these as money flows from these inactive layer 1s towards the only vertical in crypto, which is really showing signs of product market fit, which is DeFi. But the thing to remember about this is that it's going to be a bumpy ride, and that you can't have massive upside without massive volatility. But from my perspective and kind of looking at this chart, what we see is that some of these key DeFi primitives, if the thesis plays out, represent 10 to 1,000x upside opportunities. Now, please, like all of crypto, it's extremely risky and it can go to zero, and arguably has a fairly high probability of doing that. But given the magnitude of the potential outcome when it does succeed, it just doesn't have to succeed that often to make it a massively, positive expected value bet. But as with all early stage tech, it's going to take a 4 to 8 year hold to really realize these outcomes. And so we have to kind of try and zoom out of this, because there's going to be many cycles like the yield farming one right now, kind of boom and bust cycles, mini boom and bust cycles on the way. And I guess unlike venture capitalists who normally invest in early stage technology, crypto has liquidity, which gives investors the possibility and therefore the temptation as well to sell. And to me, this is both a blessing and a burden, right? Because when you look at any of the top performing public stocks, you can see straight away that you cannot have, from Amazon to Google to Facebook, you can't have 10 to 1,000x upside potential without extreme volatility and occasional large drawdowns. I think Amazon has had over 40% plus drawdowns in its history. And obviously, crypto is much earlier stage than these public companies, but by necessity. And so the volatility will also be like even higher than that. So yeah, that's kind of that's the long-term thesis. And then the only thing I'd like to do is a little caveat regarding the macro situation. So if we go to the next slide, what's important to remember about DeFi is that it sits at the very edge of the risk curve. You've got kind of stocks, tech stocks, and then you have DeFi even past that, right? And so this makes it extremely sensitive to the global macro situation, and a move towards deflation will pose serious headwinds for crypto broadly and for DeFi specifically. Like, dazzled by the kind of recent stock market surges and risk asset surges, a lot of investors are underestimating the very real probability of a post-COVID solvency crisis. And key recovery indicators peaked in June. The dollar has recently broken out or shown signs of trying to break out. So, dollar strength is, of course, bearish for risk assets, and it's bearish for DeFi by necessity. And while we see that crypto led by Bitcoin is eventually going to decouple from the stock market altogether and from risk assets more broadly, we think this is still a ways away. And so DeFi sits in the highest risk pocket in an already high risk crypto space, and so is very vulnerable to the global macro situation. And of course, just as the yield farming causes these kind of positive feedback loops on the way up, it also causes negative feedback loops on the way down.